Well, we're live.
Good
Welcome to another
morning.
episode. How you doing?
Hello. Well, hello everyone, and welcome to our show. We have a little bit difficulty this morning, so that's why we're a few minutes behind. Uh, we're so glad you could join us today, and as always, we are here every Wednesday at 10 a.m. Pacific time. My name is Andrea Lee. I'm a pharmacy doctor and also a retirement services consultant. I'm here to share my passion for financial literacy and help you build generational wealth. I'll be providing you with financial information and tips, hoping to add value to your personal finance. So stay tuned for more. Back to you, Dr. Steph.
Hey, well, hopefully you had a great week. Our show is called wealthdoctors.us. So you can look up in the future. You'll be able to go to our website and get more information. And yeah, this week we're going to talk more about insurance. I'm Dr. Stephanie Ardrey. I am the CEO of Zeniverse Wellness Group, but also involved in advising and scaling early stage companies around capital capacity and customers, hoping to encourage you all to build generational wealth using your entrepreneurial desires and dreams. I especially focus on real estate, insurance, and other financial vehicles that assist you along that journey. So today we're picking up our conversation where we left off last week. We were discussing some uses around insurance and how insurance could be utilized for not only your personal wealth building journey, but also continuing your business and other uses beyond just so-called your life or a death benefit.
Right. Before we go into all those good stuff about different life insurance and details, I still want to share with you a story. This last week, I ran into my colleagues. She's in her 60s. Uh, she she looked really sad. And I asked her why, what happened? And later on, I found out that she has two younger brothers in their 50s had passed away due to certain critical illness back to back, about 1 month apart in December. And one of the brothers' wife also fallen ill because of all this thing that going on and passed away too.
Wow.
It's just devastating. It was devastating for the family to bear this loss. Um, and she was absolutely down. I mean, really sad. And in the light of this, fortunately, the brothers had life insurance, and that was they were able to lift the financial burden for the family that left behind. So they're really happy about, I mean, that part that they don't have to go through the financial crisis of due to the loss of a family member.
Well,
So,
typically that's what I see happening. Yes, is sometimes it's that death, you don't necessarily know when your time is going to end in this existence. And a lot of times it does create a burden on families if it is that you have not prepared accordingly.
right. Untimely deaths are too common, and we often don't plan for the unexpected events. Uh, I've seen like family that drain their life saving to pay for medical expenses, but it doesn't have to be this way. By planning ahead, you can have the peace of mind and also avoid the financial hardship that you're going through with these events.
And planning is the part, planning is the key.
Exactly, exactly. So back to our this week discussion. Last week we provided different types of insurance, like an overview, and we ran out of time, so we didn't have a chance to complete our discussion. But this week we continue and focus on whole life, index universal life, and variable life or universal life. Our goal is to provide you with information you need to make informed decision when you choose the right plan for yourself.
Absolutely. Well, it's so funny you said that because I was thinking about, again, having a wealth of knowledge and resources. So, one of the, I don't know, did you read the book? I'm sure you have, Jake Thomas's book, Money, Wealth, Life Insurance, and where he cites all the different examples and uses. And a lot of times when I share with people some of the major organizations that, for example, not only currently carry life policies for business purposes, but really historically, some of the companies and early entrepreneurs who would have faced financial ruin had it not been for the fact that they had life policies. And more importantly, as I always say, if you are putting your money in the banks and the banks are putting their money in life insurance, hmm,
Exactly.
maybe that's
Right.
something you should consider. I always
You,
say follow the money, and the
right.
money is not in the bank.
You know, Walt Disney, Foster Farm, J.C. Penney had
Yes,
invested in life insurance, and they used that to fund their business in the early days of the
absolutely.
company. Yes,
Absolutely. But not only when you talk about what companies utilize insurance in the early days, is thinking about the companies right now.
right,
Companies like Harley Davidson, Nestle, AT&T, Procter and Gamble,
right.
CVS, Office Depot, KB Homes. There's a list and list. Verizon. McGraw-Hill, Pacific Gas and Electric. Bed Bath and Beyond. I bet you they cashed in on those policies. So there's the list goes on of companies that utilize the benefit of life insurance as another protection for the assets, but also as a resource to be able to borrow against and to also protect the capital that they have. I think Warren Buffett was quoted in many things, but one in stating that the importance is to preserve your principal and
Exactly.
have policies that protect you from the down cycles because economic cycles are going to continually transition between boom and bust. That's
Right.
just the flow of an economic system. It's not always going to be in one state. And so you want to have a hedge against the downturn. When it is we're in a bear market as opposed to a bull market, what type of resources do you have available? We're in a recession as opposed to a growth cycle. What type of resources and tools do you have available in making sure that you're planning for those things? So, there's not only the business application, but certainly the personal application. I think personally we can learn a lot by recognizing how businesses function within our society.
Also the inflation and market volatility. So the insurance aspect of it can protect you from that. Today, I wanted to share with you also one of the biggest myth about insurance. People say, I don't need life insurance, have through my work. But the truth is, life insurance offered through your employer is a great, great benefit while you have it. But if you leave the company, their insurance coverage does not leave with you. And the coverage amount is usually just a flat amount or equal to a year of salary. And that amount may not be enough for you. So while you have the option to sometimes convert that policy into a permanent policy, but a separate life insurance policy stay with you no matter where you work or who you work for, that is very important because that is a peace of mind for your family. And also, life insurance is considered one of the pillars of personal finance. So it should be deserving of consideration for in every household. So if anyone relies on you financially, you need life insurance. And no one wants to suffer financially if you run into a critical illness. Considering using life insurance, as a financial tool that helps those that behind cover the cost of final expenses, outstanding debts, mortgages, plan educational expenses, and loss of income. That is the most important one, loss of income, because the breadwinner, aftermath of an unexpected death, uh, the life insurance can lessen that financial burden and also help the family in time of need for the surviving family members while dealing with the loss of loved ones.
It's true. A lot of times, again, we don't think about the impact. Earlier, I was watching some of the Senate hearings that are happening right now regarding tech companies. And sadly, this was about the protections that the U.S. is looking to put in place in terms of bills that have been authored but have failed, if you will, to be approved to make it past the approval process. Of course, that being because of the lobbyists and other things. But what was interesting is the reference was around the parents who were there because of a loss of a child, and how devastating it is to lose a child. You know, parents think that they're going to outlive their children. But what happens if, unfortunately, you lose a child? You're probably going to be pretty devastated. You're possibly
Right.
going to struggle with being able to maintain focus. And even if you're the breadwinner, you know, how do you sustain yourself while you're dealing with the healing process necessary in dealing with a tragic event like that? So again, it's important to make sure not only that you protect yourself, but that you also carry policies for your children, because the family would be impacted adversely if any one of your loved ones were to perish unexpectedly or expectedly. And sadly, if someone has a chronic condition, it's more difficult to insure them once that condition has been established. So again, if it is that you take on policies while your children are young and healthy, then you are able to also utilize that policy as a place to put resources that can be available for any number of opportunities, be it, being that helping your children become their own bank, so I think you prepare for, in the event that something happens that's undesired, but you also are preparing for the opportunities that you're able to finance based on having resources available.
Absolutely. I mean, starting a policy for a little child when they're little, that's giving an opportunity to grow that policy, to grow, to compound that interest over the years. So it's a tremendous opportunity for the little kid and also for the parents to plan in the long run. So it's great to, when you consider a policy for yourself or your family or for your little ones, it should be a whole family planning together so that everybody have something to protect and also to grow from that seed of money. Yeah.
Oh, yeah. And it's interesting you say family planning. I think that that is something that more families should entertain. I noticed that there's a difference in how families approach it. And it seems like it's based on, in some cases, socioeconomic levels, because it seems that families obviously who are wealthier, that may have family offices and other support systems in place, they spend more time understanding that it's about preserving and extending the resources across multi generations, while families that are typically at the lower end of the spectrum are caught up in the day to day and not realizing the importance of planning and preparing. It's a funny thing because I was on a social media platform yesterday, casually for 2 seconds scrolling through, and I saw a person posted a reel about this wig. And the two wigs were available for either $25,000 or $27,000. And
Wow.
so I immediately posted that for my team to see, because there had been some conversations about why we're in the wellness resort business. And so we offer people an opportunity to have fun, destination travel, but also kind of peek under the hood and see what's happening in terms of their wellness journey. And someone had said, well, there are certain people who cannot afford to pay for this. And I'm like, what do you mean? These people can afford. They're recognized as being part of a multi-trillion dollar, set of resources that are allocated. So it's not that they can't afford, it's about the decisions that they make with the resources that they have. And so I said, if someone would not be placing an advertisement for a wig that sells for $25,000 or $27,000 if somebody is not purchasing it, number one. And number two, if you can pay $25,000 to $27,000 for a wig,
Oh, wait.
then you know that money's gone, right?
Right.
What's the value? What's the return on investment? If it's on your AZZ, it is not an asset, is what I often say. So, I explained, kind of to the team that, hey, the sector that we occupy already has folks who are using their resources because they believe in the importance of their wellness. Otherwise, there wouldn't be trillions of dollars being spent in this particular
Yes.
sector.
Yes.
So clearly, that audience that would pick, something
Right.
different than their wellness, that's not our customer.
Right. There is a budget for everything, depend on what important to you. Your
Yes,
health, your wealth, your personal finance. So it's dependent on what important and how you allocate that money is important.
exactly.
So let's jump into the whole life insurance. Whole life insurance is the most is the most common traditional form of permanent insurance. Whole life will remain in force if the insurer, as long as they're paying the premium into the plan. The face amount of the policy is fixed, and the premium remain level throughout their insured lifetime. So these policy are designed for individuals who wants guarantee and focus on providing debt benefit protection over the cash accumulations, basically. What are the benefits that you think the person could own, like a whole life policy?
Well, again, it's a hedge against things like, tax, inflation, security. One of the examples Jake makes in his book is talking about, where we've had significant um, market resets, bear markets, where significant value of, say, 401k or stock portfolios that have lost, 80, 90% of their value, and the length of time required for those portfolios often to rebound. And so you just want to have diversification. You want to have, and you also want to have access to liquidity. Because a lot of times, when people say, well, I have this particular policy and I have my real estate. But the thing that happens is sometimes you can't get access to liquidity. If you have to sell your real estate, if you have to go through a
Right.
loan application process, those things can be time consuming and may not be options when you find yourself in a critical timeline or in an emergency situation. So, a whole life policy, and especially the policies that are being written today, often include things like, or can have additional riders like long term care, like in the event that you receive a prognosis regarding a critical condition or a chronic condition, again, where you need additional resources to finance your care. Education, if you don't want to have your kids taking on student loan debt, being able to leverage those resources, and also, being able to have access to purchase a home. We talk about, what are life events, getting married, those types of things. So a bunch of uses for your whole life
Right.
policy.
Yeah, the whole life policy is very useful. It has a guaranteed debt benefit and a guarantee cash value too, but usually it's lower cash value compared to other policy that we're going to talk later on. The guarantee cash value can be minimal because of the low interest, but it is guaranteed. And also possible potential additional cash value by dividends declared by the company. And usually this is happening once a year. The dividend payments are generally declared annually by the company, and it's not guaranteed. But it's there as an option for the whole life, depending on the company that you going with. Also, the level premiums are guaranteed and never change for the whole life. Uh, because of the guarantee aspect of it, the cash accumulation is lower compared to like an index universal life based on index strategies. Um,
So
the
explain that a little bit, because although you're using the term, maybe people don't understand how to make a distinction between the two types of policies.
The whole life is basically guaranteed death benefit level premium,
Mm.
little cash. There's some cash accumulations, but it's lower compared to the index and universal life. And also
And
the
so the
cash
index is tied to very indices.
index,
Yes.
different indexes,
Hmm.
which we're gonna go next to the IUL, which is the index and universal life. But the cash accumulate in the policy for the whole life is usually until the amount of accumulated values equals to the face amount, and when the policy matures. So whole life policy by designs are scheduled to mature when the insurer reaches age of 100.
Mm.
And
A
why
hundred. A
right,
hundred, is that now the new marker? I know I was looking at a policy, and it seems that the actuaries are now actually going up to 120.
right. It should be going up to 120 because we are now living longer and longer, right? I have
And people
seen
think that I'm playing when I say full life is 120 and beyond. It's
whole life,
like,
whole life it is 120 now because we are living longer. I've seen so many uh, from the pharmacy side, a lot of people are living over 100 and they are wealth and healthy.
yes, yes,
Yes, so we
yeah.
have to plan far, far in advance. Now the technologies are improving, medicine are improving, people living longer, enjoying longer life.
It's important because you certainly don't want to outlive your money. That's the other thing that you must consider,
That is one,
And a lot of times, if they, people say, well, retirement is, 65, 70 years old. But if that's the case, how many more years should you be able to maintain? But also, there's a thing that one needs to consider around tax decisions. And I recommend that you make sure that you speak to a CPA, a licensed professional, regarding what tax status you have during your working years when you have more deductions versus as you mature. We don't know what the tax rates will be
right,
the point that you need to access your funds, which again is really important, an important distinction, that if you have policies, a lot of times you can access some of your resources by taking a loan against the policy, as opposed to necessarily receiving the policy, like if you were trading real estate. I was reading an article a couple days ago talking about why so many boomers, with a desire to downsize their real estate, their primary residence. This one family in particular, they were using as an example, 5-bedroom home. They're in their 70s, 80s, and would love to downsize, but they can't afford to downsize because their capital gains, the taxes on the capital gains, if they were to trade their real estate, leaves them with fewer resources. So they really can't afford to buy based on the housing prices in the
right.
area that they would like to live. They can't afford, they're priced out. So they have to
Yes,
stay and keep the big house, which also means that then if you have limited inventory, then it's also what's preventing access to certain markets, because it keeps the house prices high. Because if there's limited inventory, then there's limited supply to meet the demand. That keeps the price high.
right. I mean, at that point when you retire, there's our provisional incomes that you have to consider, and tax is the major issue that you need to consider and plan how to minimize that tax bracket so it doesn't affect, your Medicare benefits. Next,
Mhm.
our IUL, which is Index Universal Life. This may be ideal for those who need death benefit protection, but also focus on cash value accumulation for a lifetime, such as supplemental income retirement. And also, a lot of companies are offering living benefits along with these plans and cash access to your money whenever you need it most. These offer increased death benefit may be subject to additional uh, when you contribute more to the policy. So it's flexible debt benefit. It can be adjusted. It can go up, and also flexible premium. So if you sign up for a policy and you want to contribute more to the plan, you can do that. Or there are times that you run into a situation where uh, financial hardship, you need to reduce that amount, you can too. So it's not level the same as whole life. So this one we give you more flexibilities in terms of premium adjustment, and the cash value grows based on an interest crediting strategy that based on an index like S&P 500 or Nasdaq. The downside protection from the through minimum guarantee ensure that your cash value will not decline due to increased market index. So it's very useful to have an IUL or consider having one because the flexibilities and the benefits that it provide you, tax-free gains, uh, tax defer gain, but when you access your money, it can be tax free. So there are different strategies to do this. And if you want to sign up for a whole life or an index universal life, especially index universal life, will give you the cash accumulations. Talk to your financial advisor or financial professionals to structure it the right way so that it maximize your cash accumulation or depending on what your goals is, debt benefit or cash accumulation at that point. So it needs to be structured the right way to maximize it.
And that's so important because, you just said, dependent upon your goals. The reason that it's important to speak to an individual set of financial, legal, and professional advisors is what is your plan? What is your plan? What is your end game? Again, I reference a lot of times when we talk about the journey of how we set intentions and we go forward to accomplish those outcomes. It's all about planning. And most people spend time planning everything else except for the critical things such as their life plan, but their legacy plan. What type of legacy are you hoping to leave? And how will that legacy be financed? You hear about many of the wealthiest in the world making pledges of how they like their wealth to be dispersed, the giving pledges where they want to put their vast resources to work, contributing to advances for humanity. Would you like to do something like that? You could use your life policies to create funds that could be allocated to support your most cherished causes. I don't know if you saw the commercial. There's a funny little commercial where they're reading the will and the cat inherits the beach home.
Oh,
and
nice.
and the because there's it's a commercial for Chewy, which is a subscription for food delivery. So the cat inherits the Chewy subscription and the beach
Oh,
home. And the heirs are going, what? How did the cat, who's caring for the cat? The cat is suddenly able to care for itself.
yeah, that
But it's
ties to
funny.
emotional value, right?
So that's just, kind of a funny example, but really a reminder of who's going to inherit, the resources if there's resources to be inherited. But how about be deliberate? Because we're all going to arrive at some destination. It's a matter of, is it the destination that we chose, or is it just a destination that we end up at because of lack of planning?
Right, exactly. Is if you plan in advance, you can have everything and see everything. So it's expect the unexpected, right? Um, So lastly, we wanted to touch on the variable life insurance. When we talk about variable life insurance, the guarantee is depending on the claims paying ability of the insurer. So it does not protect the value of variable products portfolio because it's fluctuate based on and the investment risk. So basically, the debt benefit, there is a minimum guarantee, but it fluctuates and it could go down. The debt benefits can be flexible. The premium can be flexible as well, but the cash grows on the performance of based on the professional managed stock or the money market sub accounts. So there is risk along with this type of account. So you have to be careful if you get into a variable life policy, it ties with the market volatility. So with the stock market, so it fluctuate based on that, and the value you invested in could lose the value, also including the principal. So it's important that you understand what is variable life and how to maximize it. It's a great choice to be, to hedge against inflation, but also there's a lot of risk. So you have to consider your risk tolerance if you choose to go with variable life insurance.
Also the
Um,
time, I would say, because if you're younger and you're able to, if you will, rebound from any, market setbacks, how much time do you have in order to recapture? But that's why it's so important to have a diversified strategy,
right,
because you need to diversify how your assets are allocated, and you need to pay attention. It's
right.
not a one and done. I think that that's probably the biggest point that hopefully people will take away. And you also, I would say, like you do anything else, interview and speak to a number of different professionals, because each professional is going to have their particular, bent or perspective. When people come and speak with me, I always let them know that, listen, my belief is that generational wealth is possible and important. And these are some of the asset classes that I've studied that tend to be common as part of the diversification strategy of those that have typically built wealth. So that is going to be my bent, is that I'm going to be leaning towards looking at how you can utilize some of these strategies. Someone else may have another, focus or bend. So you need to understand what is the perspective that the advisor is advising me from, and is that consistent or along the lines of the plan that I am seeking for myself, my family, my legacy. Because not all advisors are made the same. They're not.
Exactly. We all have different perspective. We have different specialty. So speak to multiple advisor will give you more like a range of options that you can go with, depending on what your goals and your objectives are. Well, thank you for joining us today, and we appreciate you, and hope that you found this session helpful. We go live every Wednesday at 10 a.m. Pacific time, so please join us next week for more exciting content. Until then, we encourage you to take care of yourself and your loved ones. And if you don't have a plan in place, please consider creating one. And if you already have a plan, we recommend to review it, update it to ensure that is the best for you. Have the most wonderful day.
Take care, everyone. We'll see you again next week. Don't forget, look out for wealthdoctors.us, Dr. Stephanie Ardrey, and Dr. Andrea
Okay,
Lee.
Andrea Lee.
We'll see you next week. Take care.
Thank you.